Hello everyone, welcome again. In this lecture we'll continue with corporation tax, and now we will look at overseas aspects of corporation tax. So when the company is called UK resident company, what if the company is non-UK resident? Will we have to pay corporation tax on that and stuff like that? So I'll share the screen with you and we'll go through the notes together. That is page number 84 of your lecture notes. Overseas matters for companies. Right, company residence first of all. So when a company is called UK resident company, bear me 1 second. Yep, I got it. So UK resident company, how to determine if the company is UK resident or not? Now there was different criteria for individuals. Now for companies, it is a little different criteria. So if a company is incorporated in the UK, that will be called a UK resident company. Now if the company is not incorporated in the UK, if the company is incorporated overseas, however central management and control is exercised within the UK, then also it will be considered as UK resident company. Now what is central management and control? Now when board of directors meet in UK, say for example London office, then it will be considered that central management and control is exercised within the UK. So either the company is incorporated in the UK, that will be UK resident company, or if the company is incorporated in France, however the board of directors meet in London office, that will be considered as UK resident company because central management and control is exercised within the UK. Right, so as you can see on your screen, a company is resident in the UK if it is incorporated in the UK, or if it's central management and central management and control is exercised in the UK. Central management and control is usually treated as exercised where the board of directors meet. A UK resident company is subject to corporation tax on its worldwide profits. So if it is a UK resident company, the company will have to pay tax on the worldwide profits. What is permanent establishment? So if the company makes office in France, then another office in Germany, another branch in Italy, and like that. So another factory, so you can say in Malta. So there are different types, subcategories of the company. However, if it is a franchise, the franchise is something else. It is not permanent establishment. So basically, another branch of the company in another country is called permanent establishment. And permanent establishment is overseas. So profits of foreign permanent establishment includes a branch, office, or a factory of a UK resident company are treated as part of the profits of the UK company and are normally included in its computation of the trading profits. So wherever your branches are or the factories, you will have to take them profits and it will be included in the main company's profits and you will have to pay tax on that. However, you have one option. You can say to HMRC that I don't want permanent establishment to be taxed in the UK. Now if you do that, then you will have to select all of them permanent establishment which are abroad, not just one which is loss making or is making too much profit. So what you have to do is you will have to select all of them. Now when you select all of them, when you say opt to do that, so when you said that I don't want my foreign establishment, permanent establishment to be taxed within the UK, then because they will not be taxed in the UK, then you will not be able to claim the loss relief either from them permanent establishment. So if you are paying tax on permanent establishments, then you will be able to set off the loss relief against them. However, if you opt out to do that, so the permanent establishments will not be taxable in the UK, then you will not be able to take the loss relief as well, right? So you will lose the loss relief. So whenever you are making the decision whether to include them in the corporation tax, so whether you want them to be taxed in the UK or not, then what you have to do is you will have to see that what is the double taxation relief, because only then you will be able to make the decision, right? So we know that how to calculate the double taxation relief, like in other taxes, like we used to do in other taxes. So double taxation relief will be, first we will calculate the tax in the UK on them overseas profits. So you calculate the tax liability, and then out of that tax liability, double taxation relief will be given double taxation relief will be lower of UK tax and overseas tax. So whichever is lower of them, that will be deducted out of this liability, and that is called double taxation relief. So you will have to see the double taxation relief, only then make the decision, because you will be losing the loss relief option otherwise. So profits of a foreign permanent establishment include a branch, office or factory of a UK resident company are treated as part of the profits of the UK company and are normally included in its computation of trading profits. A UK company may make an election to exempt the profits and losses of all of its overseas permanent establishment from the corporation tax. If such an election is made to all of the overseas permanent establishments, and no loss relief will be given if incurred by overseas permanent establishments. It is advisable to consider double taxation relief before making such an election. Right, so exactly the same thing which I just mentioned to you. And double taxation relief, we know that when it is a permanent establishment overseas, then you might be paying tax overseas, and you will have to pay tax in UK as well. So in them cases, UK government will say, HMRC will give you double taxation relief, which will be lower of tax which you have paid overseas and the tax which you will be paying in the UK. So UK tax on overseas gross income and overseas tax on overseas gross income, it will be lower of that. Right then, next is a controlled foreign company. Now, controlled foreign company is a company which is a resident overseas, however, it is controlled by the persons within the UK. Now, when I say persons within the UK, they are UK resident persons. Now, persons means individuals and companies, right? So it says a controlled foreign company is a company which is resident outside the UK, but is controlled by the UK resident individuals and companies. Now, if UK resident individuals and companies have shareholding of 50% or more than that, then it will be considered as UK. It will be considered as controlled within the UK. Now, if it is a controlled foreign company, then what would happen? Income profits of the controlled foreign company are apportioned to UK resident companies entitled to at least 25% of those profits. Now, please read this statement carefully, because there are lots of things going on in here. It says that only income profits, we're not talking about the gains, only income profits. So if the company has got gains, I'm talking about CFC, controlled foreign company. If controlled foreign company has got profits and the gains, we are only talking about the income profits, we're not talking about the gains. So we will take only income profits, and if any company which is UK resident company owns 25% or more in a CFC company, then that proportion, whatever the 25% is or 30%, right? So that portion, 30% of the CFC profits, only income profits, will be taken. So we are only talking about UK resident companies. You're not talking about individuals. So if an individual who is resident in the UK is entitled to 30%, he has got 30% shareholding in CFC, we won't take them profits. We only take profits of the company which is resident in the UK, right? So a UK resident company which hold more than 25% in CFC, we only take them profits according to that percentage, not for individuals. So income profits, not gains, of a CFC are apportioned to UK resident companies entitled to at least 25% of those profits. UK corporation tax will be paid on apportioned profits. Now, UK tax rate is 20%, we know that, so you'll have to pay tax on that. Right? Right then, so after that it says on the next page, if you move to page number 85. Right, on page number 85, CFC charge will be reduced by creditable tax, which is aggregate of the following. So it is in total of these things. What are these things? A double taxation relief, income tax deducted at source on income received by controlled foreign company, and corporation tax payable in the UK on any CFC income taxable in this country. So all of these things, whichever you see in the question, it will be reduced by this thing. I'm talking about controlled foreign company charge. As the profits of the controlled foreign company will not be chargeable to UK if any of the following conditions apply. So what are these conditions? The tax paid overseas by a CFC company is at least 75% of the tax which it would have paid in the UK. Right? So if whatever tax they have paid, whatever tax CFC has paid in the UK, So if it is 75% of the tax, if whatever they would have paid in the UK, so if they paid, say for example, if they would have paid £100 in the UK and they paid £75 overseas, then that's fine. Though you don't have to pay any tax in the UK. The other condition is that CFC's profits do not exceed £500,000. So profits do not exceed £500,000 and capital gains do not exceed 10% of that. And its non-trading income does not exceed £50,000, right? So these both conditions need to be satisfied, and if these two conditions does not satisfy, then the other condition, which is the first one, must be satisfied, which says tax paid in overseas by the CFCs at least 75% of the tax which they would have paid in the UK, right? Right then, so we'll look at a question now. Another question which you can see on your BPB exam kit. Question name is Club PLC and question number is 24. It's the past exam paper which was examined in 2014 December attempt. Club PLC, if you want to find out in your own exam kit, if you do not have BPP, question name is Club PLC and it was examined in December 2014. Right? Alright then, so let's move to the requirements section. If you move to requirement number C, please. In part C, part 1, it says explain whether or not Hart's company will be regarded as controlled foreign company for the year ending 31st of March 2018 and the availability or otherwise of the low profit exemptions, right? So it says that tell us if Hart's company is a controlled foreign company or not. First thing is to identify if it is a controlled foreign company or not. Second thing, it says that tell me if controlled foreign company CFC charge will be applied or not, because I think that exemption will apply. Now what were the exemption? There were couple of conditions. The tax which they have paid in the overseas country is 75% of the tax which they would have paid in the UK. That is condition number 1. Other condition was that profits are less than £500,000 and capital gains are less than £50,000, right? So these are two conditions. Now if these two conditions are satisfied, or any one of these conditions is satisfied, then exemption will apply. Right, now first we have to do the scenario so that we can identify what's happening. I will read from here. Club PLC is a UK resident trading company, has been charged a penalty in respect of the late filing of a corporation tax return, intend to establish a tax advantageous share plan, purchase 30% of the share capital of Hart's company excuse me, from Mr. Jack. So 30% is owned by a UK resident company, which is Club PLC, right? So 30% is owned by UK resident company. So it will be considered as controlled foreign company if it is, if it is controlled within the UK, if the control is exercised within the UK. Right then, so 30% is, owned by Hart's company. 30% owned by Club PLC, which is a UK resident company. Now, if you come to this portion which says Hart's company, as you can see on your screen, Hart's company is a resident in the country of Suta, and it says Mr. Jack continues to own 25% of the company's ordinary share capital. Now it says that 25%, this company is resident overseas, and it says 25% is owned by Mr. Jack, right? So 25% is owned by Mr. Jack, and 30% is owned by 30% is owned by Club PLC. Now, Court Company, a company resident in the country of Suta, owns the remaining 45%. Now, 45% is owned by overseas company, 30% is owned by UK resident company, but we are not sure, the information is not enough about Mr. Jack. What's the name? Yeah, Mr. Jack. So we do not know anything about Mr. Jack yet. If Mr. Jack is UK resident person, then this 25% will be UK resident, that 30% by Club PLC will also be UK resident. So altogether 55% will be UK resident, so it means that it will be a controlled foreign company, right? Only if Mr. Deck is UK resident. Say for example, if Mr. Deck is not UK resident, then it is so obvious that it won't be controlled foreign company. Right, then after that it tells us budgeted results of horse company for the year ended 31st March 2018. So it tells us the results of them. Now let's read the requirement again. In C part where it says explain whether or not horse company will be regarded as controlled foreign company. So we'll have to tell that 30% is owned by Club PLC, 45% is owned by a non-UK resident company, and information is not enough about Mr. Deck. I think his name was Mr. Deck. So information is not enough about Mr. Deck. So if Mr. Deck is UK resident, then this company will be controlled foreign company. If he is not UK resident, this company will not be a CFC. And in the other section it says that bear me 1 second. It says and the availability or otherwise of the low profit exemptions. Now it says that assuming if it is a controlled foreign company, tell us that if the exemption will apply or not. Now in order for the exemption to apply, first condition is that tax paid overseas will be 75% of the tax which they would have paid in the UK, and the second condition is profits are less than £500,000, capital gains are less than £50,000. Now we'll have to see the information about it. So in the budgeted results it says trading profits of £30,000, right? So trading profits are less than £500,000, all right? So this condition is satisfied. Now look for the capital gains. Capital gains needs to be less than £50,000. So the other information says a chargeable gains of £70,000, right? So this says, it means that this condition will not satisfy, right? So it means the exemption will not apply because capital gains are more than £50,000. All of the house company's profits have been artificially diverted from the UK. A house company will pay corporation tax at the rate of 11% in the country of SOTA. A house company will not pay a dividend for the year ended 31st March 2018. Now read the other requirement as well. What does it say in the other requirement part 2? On the assumption that horse company is a CFC and that no CFC exemptions are available, excuse me, calculate the budgeted CFC charge for Club PLC based on the budgeted results of horse company for the year ended 31st March 2018. So it asks that tell me that how much will be the CFC charge, right? So let's see. So how to calculate the CFC charge? Only income profits, not the gains. Only income profits attributable to UK resident companies, not individuals. Right? So let's look at the profits. How much are the profits? Profits are £330,000, and attributable to UK resident companies. Which company owns in this company? Which company has got shares? Which is UK resident company? Club PLC has got shares, which is UK resident company, and Club PLC has got 30% shares in this company. Right, so we'll take 30% of this profit, £330,000 multiplied by 30%. Let me grab my calculator. So, give me 1 second. £330,000 multiplied by 30%. So, £99,000. So, £99,000 are, £99,000 are the profits which are attributable to UK resident company, right? So £99,000, and you'll have to pay tax on these company on this amount. So £99,000 into 20%. UK tax rate is 20%. So it is 19,800, right? So 19,800 is the tax liability. And please remember that CFC charge will be reduced by some amounts, right? So it was accumulation of these three things, right? One of these things is given to us in the question. It says horse company will pay corporation tax at the rate of 11% in the country of SOTA. So we'll have to take 11%, which is lower of it is double taxation relief. So double taxation relief will be lower of UK tax and overseas tax. And in this question, 11% is lower of 20% anyway. All right. So £99,000 into 11%. So £99,000 into 11%, which is lower of 20%. So it comes to 10,890, and that will be deducted out of that. and it will be lower of UK tax and overseas tax, right? So it will be deducted out of that, and the eventual thing, whatever the difference is, 19,000 something less 11,000 pounds, the difference is going to be our CFC charge, all right? Because it is calculated in this way. Right, then anything else he's asking about on the assumption and budgetary reserves? Yeah, this was the thing which he was asking, and it was only 3 marks worth of a requirement. So that's it for this requirement. All right, so it was question number 24. Please make sure you redo this question so that you're comfortable with this rule as well. Right then, so that's it for this video, and I will see you in the next video, and we will continue with the corporation tax. Thank you very much and goodbye.